Hey everybody, welcome to We Get Macro, where we're going to continue with our class about the financial system that involves savings and investment. So the idea behind this video is that we're going to further understand and connect savings and investment with the GDP formula. So can we derive a national savings through a GDP formula? That's what we're going to investigate here. Okay, it's also going to give us some more experience on dealing with economic models. Okay, even though it's a very simple one. And we're going to even further decompose national savings into both private and public savings. Okay, I know this is math, so please let me know if you have any questions, and we can, as always, chat over office hours. So let's think about this. How can we connect our GDP formula, which I warned everybody that was going to come back to throughout our class? How can we? Where is it? Wait a minute. There you go. Perfect. How can we incorporate national savings into this equation? Okay, well, the first thing, let's quickly recap our equation, right, which starts with output, which in this case is real GDP, right? That's our gross domestic product. Then we're gonna have consumption, that's the household side of the GDP equation, investment, the firm side of the GDP equation, government spending, the government side of the GDP equation, and then you have the trade side, which is net exports. Right. The first assumption we're going to do here, like I said at the beginning of the semester, we're going to try to simplify the models because this is an introductory class. So you're just kind of getting your feet wet here. And if you enjoy it, you can feel free to join our, the intermediate macro class that I'll be conducting in the fall. Okay. But for this model, we're going to assume that there's no trade. Okay. So another concept used for this is a closed economy. The economy is closed for trading with other countries, and that's the assumption we're going to make at least during this class moving forward and for this chapter. Okay, the opposite would be to have an open economy, which is a lot more realistic, but it also complicates the model as well. Okay, so how does this assumption of the closed economy impact our equation, and how can we derive national savings? Well, as you can see here, since it's a closed economy, net exports equals 0, which pretty much makes it drop out of the equation. Remember, you would be right here, right? So that's the first thing. Okay. Second thing, how can we derive national savings from this? One, we simplified the equation. We dealt with the assumptions made. Now, the second assumption we're going to learn here is that, and we have talked about, so we just kind of wrapping it all up, is that we know that the financial system connect borrowers and savers. There's also highlighted how to have borrowing, to have lending, to have investment, there must be somebody saving. Right? So the assumption here is that one person's savings can finance another person's investment. So we're going to assume here that the national savings is going to equal the total investment in an economy. Okay, so if we readjust the GDP formula to isolate investment, because we want to know what investment is, we would subtract consumption and government spending from both sides of that equation. Right? This would give us the following equation, where Y, GDP minus consumption minus government expenditures equal total investment in the economy. Okay, since we know based on our concepts discussed in this chapter and our assumption made that for a person to invest, another must be savings. In this case, we can assume then that the national savings is going to equal the total investment in the economy. Okay, very important moving forward when analyzing exercise with this concepts. Okay. The other concept we're going to introduce here is taxes. Why? Well, let's then further decompose what the national savings is. And can we actually decompose that into private versus public savings, right? So let's think about what the definition of those concepts, which will allow us to think better about how to generate these equations, right? So what about public savings, right? So for public savings, we're trying to see, hey, government makes a certain amount of money, revenue, which then he used to spend and into its government expenditures, right? To promote infrastructure projects and other things that the government has to pay, military, right? So how do we investigate that? Well, how does government make money? Taxation, right? Through taxes. And then we just simply subtract government expenditures, okay? That will be our measurement for public savings. As you can see, I did that pretty much intuitively, okay? What about private savings? So private savings here, right? Going to be what is not public savings. So it's going to come from, in this case, the households, right, and firms. Okay, so in this case, well, we already have the investment side being isolated, right? Remember that both public public savings and private savings would be national investment. So the first assumption we made here, right? I guess I can put it on the top. Apologize for that. It is that, oops, is that national savings is equal to private savings plus public savings. It must be that both private and public equals the total investment in the economy, right? So how can we decompose from the GDP formula what is private savings? Well, we know there's a output in the economy that's total production. And we know that from the total production, people are going to consume, right? And not only that, people are going to have to pay taxes. That's it, right? That would generate us private savings for this model that we have, okay? Very simple, very simple. And as you can see here, we could rewrite this equation into its decomposed terms, okay? But as it points out here right on the bottom, as you can see, I highlight here for you guys what both private savings and public savings are, okay? More than that, we also further specify two characteristics of the public savings, right? If government is generating more tax revenue than it's spending money through its government expenditures, we know that there is a surplus, right? The government is able to save more money than save money, right? But if we have the opposite scenario where taxes are not enough to pay government expenditures, now we're going to have a government deficit, okay? Which I'm sure we all have heard a lot about, okay? So moving forward, there's this really cool exercise. I will not solve it right now. I want you guys to give it a try. Please use the previous slides, so especially this previous two, where it defines the GDP formula, the assumptions needed to solve these models, this exercise, and explains the decomposition of national savings through private and public savings to then solve this exercise. Okay, we can use the virtual classes to be able to discuss, and I'll give it a little bit, but then I'll post a video with the answers for a solution for this exercise as well, so everybody can see it. Okay, but I want everybody to really give a good try. Okay. Besides that, I just want to show you guys. So since we're talking about public savings and debt, I just want to show you guys just so you can get an idea about total public debt as a percent of gross domestic product. Okay, so how much debt do we have? And think about debt in the U.S. being an accumulation of a sequence of budget deficits, right? So if every year we don't generate the amount of taxes that we need to pay for our government expenditures, then we have to borrow money, right? We're making an intertemporal decision to borrow from the future, which borrow simply means that, hey, I'm choosing to consume now, to borrow that money now, but then I'm going to have to pay that back later with interest, right? So we're hoping that that investment now will pay off enough where we're not suffering with the consequences of not only paying all that money back, but also have to pay an extra interest and not being able to, okay? And as you can see, the U.S. have been borrowing more and more over time. There's periods where it reduced its federal debt relative to the size of the economy, right? But over time it has gone up. Now, is this something to worry about? I don't know. I would say that you need to look into a lot of factors to understand whether this will matter or not. Does this matter? Period. Yes, it does. Now, to what level? It depends on the situation of the economy. So, for example, when Argentina failed in the 2000s, failed paying its bonds back, right? At that point, it definitely matter how much that they have, and it's definitely going to matter moving forward that everybody's going to watch more Argentina and say, hey, their levels of debt is getting really high. Let's not lend them money, right? But for the U.S., we're still seen it as a powerful economy, right? We are seen as a powerful economy. We are a powerful economy. Not only that, we also are the owners of the dollar, right? The dollar is the most stable currency in the world. So right now, if somebody's worried about somebody's failing, they're not worried about the U.S. failing because we're the biggest power in the world, right? So in this case, this is why this is not that worrying for me, at least in my view. And I incentivize you to have your own, to think it through. And this is a discussion that we can have as well when we talk in our virtual class. Is that, what do you think about the debt? Is it a problem? At some point we have to pay it back, right? That's the question of when we're going to be able to do that. Which generation is going to accept that at some point we're going to have to raise taxes and diminish our spending so we can finally pay back this what I want to call intertemporal decision-making problem, right? Be able to decide whether you want more now or later, right? If you want more now, you probably need to pay more later. But if you want more later, then you have to reduce how much you're consuming wanting now, right? That's extremely important. As you can see, this absolutely connect with the financial industry, financial intermediaries, and how households, firms, and government behaves in terms of loans and savings are all based on this intertemporal decision-making problem. Okay. Please let me know if you guys have any questions. As I mentioned, moving forward in this chapter, there's a review for the market vulnerable funds. Feel free to do that on your own. And please let me know if you have any issues, solve the math exercise that I present on this video. So then I can post that video for you guys with a solution. Okay. But give your best try. And thanks for watching this class. And we'll be back with the chapter on money and banking. Thanks very much, guys.